Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Kia ora and welcome back to Markets, Mystics and Mayhem. In this episode, we're going to be digging into the Reserve Bank's November monetary policy statement. The Reserve Bank remains in this cutting cycle. They have to be because the economy is still weak and they're growing more confident in inflation returning sustainably to their 2% target. So rate cuts, they're coming. We've got a cash rate of 4.25%. That's the lowest it's been in 2 years. Rate cuts continue to fall into 2025. That's what we're expecting. But the big question is how much further do they have to cut? And we often take our cues from the Reserve Bank's OCR track, which is their projections for the cash rate over the next 2 years. So why don't we start there? JK, how did you read the OCR track? What were your sort of thoughts about it?
It was interesting. It was a lot higher than we thought it would be, and it takes a lot longer for them to get to neutral than I thought that they would share with us. So for me, it was a track of sort of two parts. The front part's relatively straightforward. They've given us very clear guidance that they're cutting another 50 basis points in February, so that's great. That takes the cash rate from 5.5 to 4.25 now, but to 3.75 in February. That's in line with our view. We've been saying from the start that they need to get the cash rate below 4 ASAP. They're going to do that. It's the second part of the story that's a little confusing. So they cut aggressively. They've pulled forward rate cuts. They're delivering quite a bit now, but then they stop at 3.5 next year, which is not enough in my opinion. And then it's only a very gradual easing towards 3%, not until 2027. Which, that's at odds with what we think.
Yeah, so basically you're saying that the OCR track was lowered, at least in the near term, because they are moving in bigger increments than their August track, but that endpoint is higher and flatter.
Yeah, absolutely. Much higher than I thought it would be.
Yeah.
And, we've revised our thoughts on the back of that.
So what are we thinking now?
Sabrina?
Well, yes, I guess originally prior to their decision in November, we were sort of saying, okay, we expect rates to go back down towards neutral, which was expected to be around 3%. And we thought, actually, no, the Reserve Bank's going to have to come in a bit more and actually get some stimulus into the economy. And so we were saying they're going to go to 2.5%. But now, off the back of their statement, they have sort of revised up neutral a bit higher. They now see it as being around 2.9%, I believe. And their track isn't showing, us even getting to 3% until 2027. So off the back of that, I think we sort of made a collective decision, okay, this is what they're telling us. Neutral is estimated to be a bit higher. So now we're saying rate cuts will get to 3% by the end of next year, but not quite to that 2.5% that we originally had.
Yeah. So their estimates of neutral change all the time. They got to as low as sort of 2.1, and they've been revised from 2.75 recently up to 2.90 now. So that tells you that they're thinking a cut to 3% will do the job, but anything below that is stimulatory, and that's a little higher. So we've turned around and said, okay, fine, they're cutting to 3, they're not cutting to 2.5. But the message for households and businesses is still one of rate cuts are still coming. We're just not going to get quite as many as we had thought previously.
Yeah. I mean, as you say, their track is very, 70 basis points or so of cuts next in 2025. That's fewer than we were expecting, right? We're expecting like another 125 basis points next year.
Yeah. We'll take the other side of that bet again, like we have been for quite some time. We were calling rate cuts well ahead of the Reserve Bank delivering them. They ended up delivering them, earlier and harder because the data has deteriorated. And you know what, we need, further rate cuts into next year to get the economy performing in a way that you can sort of sit back and say, okay, we're done. The economy's on a good path. I think that still takes another 125 basis points. Not the 70 or whatever that they're saying.
Well, I think we should also point out something that we all kind of thought when we saw the statement come out is, are they just being really hawkish again? So last year, think back to last November, they came out really hawkish again. I think they lifted the track and said more cuts, and we were thinking, oh no. And then February, they came out really dovish, and this kind of just feels like a Mamma Mia, here we go again sort of scene, where maybe they've just, given this 3-month gap, they just kind of wanted to not see rates go too far in either direction, and then who knows what we'll actually get in February. Yes, we've sort of changed our call off the back of what they're indicating, but part of me isn't going to be that surprised if they come out in February and it's a lower track and actually we see them getting to 3%, not in 2027.
No, you're right. They have been bouncing around a bit with their commentary, hawkish in November, talking about hikes, not cuts, and then dovish in February, which caught everyone off guard, particularly a couple of the major banks, and then hawkish in May, which was just bizarre.
So then cutting in August.
Really weird, like obviously a misstep on their behalf, and then cutting in August, like you say. So they have been bouncing around, and I think that the November statement's one of those bounces in the hawkish direction that will end up being reversed, I think, in February.
I mean, it is a very long time between November and February. That's when they meet next, and we get a few more data points that'll be really important for the next decision. And we know that households are still in a pretty weak financial position. So we may not see. I know we've cut. The Reserve Bank's cut interest rates quite meaningfully, and we've seen retail banks cut their rates as well. But it's still going to take time for that to actually flow on to how households actually, change their consumer spending and all that time.
Yeah. So more cuts coming towards 3%. But there were some interesting bits and pieces in that statement. Like what were some of the key takeaways for you?
Yeah, I mean, I think for me, one of the key takeaways was that the Reserve Bank is also noticing the lift in confidence that we've been talking about, that you've definitely seen while you've been on the road. They definitely made a point that that's been a bit of an early indicator for where the economy is going from here, but probably need to put emphasis on an early indicator because will still take quite a lot of time for that sort of confidence to actually transmit into actual activity. So that was quite an interesting point. Good to know that they're hearing the signs of the pickup as well. It's not just us. We don't just have optimistic clients. That sort of optimism is spreading nationwide. But there was a couple things in the forecast as well. MJ, do you want to talk to those?
Yeah, I mean, I think there is a case actually for, rates to head on the lighter side of neutral because, again, we have a very weak economy at present. And the Reserve Bank revised their economic projections where it now looks like a faster stabilization of the economy, but towards a weaker economy. So their growth projections further out were revised down. So we are, picking up in terms of momentum, but the end point is much weaker than they had in August. So there is a case there that rates do need to go into that more stimulatory territory to actually get us going, get the economy growing back at the sort of 2.5, 2.6 more normal levels of growth. So it was interesting to see that their, projections had us going back to, a faster return to a more normal economy, but it's, a weaker economy.
Yeah. And within that, there was a special box on the sensitivities within different industries. I thought that was cool.
Yeah, I mean, it's those retail and construction
and manufacturing. I think, guys, I read it.
You have to read your question.
Sorry, there was an interesting bit.
I was focusing on the other one. I'm focusing on Sabrina.
Yeah, so basically, the Reserve Bank was looking at which sort of areas might recover fastest once interest rate cuts come, and it's of course those that are most sensitive to interest rates. So construction, you pretty much had it, MJ. Construction, retail, manufacturing, those are the most highly interest sensitive sectors. They're the ones that have done the worst in this sort of rate hiking cycle, but they should be the ones to recover the quickest as rate cuts keep coming through.
Yeah, yeah, exactly. I mean, yeah, retailing has been hit very hard by a consumer that has been hit very hard by high interest rates, high inflation, now thoughts of job, insecurity. So all these things and then falling house prices have weighed on consumers. So that'll bounce back. And then, of course, the housing market corrections put some real pressure on the construction industry. So looking for those to rebalance and improve next year is key.
Yeah.
So what part of the statement did you read?
The forecast.
Reading the forecast.
Right.
It's a very large document. And
60-something pages.
There's 3 of us, so we all take, different sections of it. You looked at the OCR track, which is just one bit. And then we looked at the economic projections, and then, there's a special topic.
Wow. That shows you how exciting the monetary policy statement can be.
And there was a press conference, okay?
All right, what do you take from the press conference then?
I think the most interesting thing was how, can I say, explicit they were in signaling a 50 basis point cut in February.
Unusual.
Yeah, that's not usually, they'll say the OCR track is a guide and we take that. But then to say that 50 basis point cut is consistent with the OCR track is, I think, the thing that, lifted my ears.
Yeah, well, we saw quite a reaction on the day, right? So the monetary policy statement came out and we sort of took the track for what it was, and it was more hawkish than what we in the market were thinking. So interest rates actually spiked, 15, 20 points initially, and then Adrian Orr obviously saw that and tried to reverse it, and he did just that by coming out and saying they'll do 50 in Feb, which is quite explicit for a central bank to do.
Okay, so JK, we know that the OCR has further to fall next year. What does that mean for wholesale interest rates?
I haven't read that bit. What it means for wholesale interest rates, they are still falling in the short end. So what I mean by the short end is your 6-month, 1 year, 2 year wholesale rates. They are linked to the cash rate, and the central bank can control that short end of the curve, and they'll do that by cutting 50 in Feb, 25 maybe in April or May, and then holding the cash rate either there or doing what we think, cutting to 3. So there's still downside momentum for those 1 and 2 year and even 3 year rates. They'll be pulled down by the rate cuts. But what's interesting is that we're seeing a lift in global interest rates that I think will continue in a volatile path next year, and our curve is actually steepening. So your short-term rates are being held down, but those longer-end rates are lifting on global forces. Some of that is Trump-related, so Trump's policies, particularly tariffs, tax cuts, and other measures are quite expansionary and pro-growth, pro-inflation. So I think that US-led lift in interest rates will feed through here, and we'll get a steeper curve.
So what does that mean for retail rates? So we're still expecting them to fall, but maybe they don't stay at those sort of low levels for as long as we'd expect without the Trump tariffs and all that stuff?
Yeah, exactly right. So we are still expecting wholesale rates to fall further, but they're not going to fall as far as we previously thought, because we've lifted our OCR endpoint from 2.5 to 3, so those rates don't fall quite as far, and the longer end rates are taking off faster than I thought. So we are getting that steeper curve. I think your 1 and 2 year rates, mortgage rates, business lending rates will hold, if not fall a little further. But those longer end rates that some businesses and households like to tap into, your sort of 3-5 year and beyond, they're more at the mercy of what's happening overseas, and there's more of an updraft for those longer end rates next year. And what does it mean for the currency?
Well, again, it's going to be, all interest rate differential driven. And we know that the Reserve Bank of New Zealand is becoming one of the more aggressive rate cutters, and their cycle is much more aggressive in terms of easing than, say, the US Federal Reserve, who may even pause at their next meeting. So they're much more gradual in their approach. So with that, you've got what that means for the currency is that it's going to head potentially lower because, New Zealand rates are just not attracting that offshore investor as much. So that sort of capital flight or whatever means less demand for the New Zealand dollar.
Yeah, exactly. So I love interest rate differentials, and our interest rates falling a little faster than the likes of the US and the Australian, so that puts downward pressure on our currency. I think we need to have a sit down with the traders, but I think that the story for Kiwi next year is in two halves. I think the first half of next year is still downward momentum and downward pressure on the Kiwi, great for exporters. But then the second half of next year, I think, global growth will be improving. I think those interest rates will be lifting offshore. And I think the Kiwi will actually be brought into a bit of an updraft. As central banks cut around the world, we get more growth, we get more stimulus. And I think that'll actually be a time when the Kiwi might actually recover up into the 60s again.
But yeah, I guess that's it for this episode, digging into the November monetary policy statement. If in case you were like me and maybe didn't read some of the topics, we kind of covered it all in this one. Special topics, economic projections, OCR track. That was all that was covered in this one. We'll be back with another one next week. Make sure you follow, like, and subscribe to this podcast, giving you all the good economic updates.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.